All right, let's dive right in. Welcome to today's Explainer, where we're going to break down the exact math behind the ultimate middle-class financial dilemma. It's a debate happening in living rooms all over the world right now. Should you put your hard-earned savings into buying real estate, or should you invest it in the stock market? Today, we aren't relying on emotions, and we aren't listening to outdated advice. We're looking strictly at the numbers. By the end of this explainer, you're going to see a side-by-side mathematical breakdown of a 30-year journey that might just change how you view wealth creation completely.
Let's start with a simple, real-life scenario featuring two friends, Rahul and Ankit. On paper, they are practically identical. They both take home a monthly salary of 50,000 rupees. They both have families to take care of, and, through sheer hard work, they've both managed to scrape together exactly 1 lakh rupees in savings. They want security, and they definitely want growth. But as we're about to see, the choices they make with that single lakh rupee will lead them down completely different financial destinies over the next 30 years. Who's going to end up richer? Let's set the stage for this 3-decade financial showdown.
Section 1, the 1 lakh challenge, Rahul versus Ankit.
Here is where things get interesting. Both guys want to secure their family's future, but their mindsets diverge. Rahul talks to his family and they give him that classic traditional wisdom. Buy a house. Real estate is safe. So, property it is. Ankit, on the other hand, decides to trust the financial markets and goes all in on stocks. Two totally different paths starting from the exact same financial baseline. Let's break down Rahul's math first.
Section 2. Rahul's real estate net. So, Rahul finds this great 3-bedroom house, but it costs 50 lakhs rupees. Obviously, his 1 lakh in savings isn't going to cut it, right? He heads to the bank. Because Rahul has a stable job, the bank is more than happy to approve a loan. But there's a catch. They require a 20% down payment. That means Rahul needs to scrounge up 10 lakhs rupees up front to secure a 40 lakh rupee bank loan. He manages to gather this down payment utilizing his savings and gathering funds to lock in his dream home. He is heavily leveraged, but hey, he's got a house.
But hold on, the upfront costs don't magically stop at the down payment. To actually register this property, Rahul has to pay stamp duty. Even after consulting a lawyer and smartly registering the house in his wife's name to snag a discounted 5% rate, that is still an extra 2.5 lakhs he didn't really account for. To cover this, he actually has to do the unthinkable. He sells his wife's jewelry. So the absolute crucial takeaway here is this. Rahul's true initial out-of-pocket investment isn't just 1 lakh, or even 10 lakhs. It's exactly 12.5 lakhs.
Now, Rahul decides to rent this house out, thinking he's suddenly a real estate mogul building a passive income empire. Assuming a very generous 5% rental yield on that 50 lakh rupees home, he's pulling in about 20,000 rupees a month in rent. Sounds awesome, doesn't it? But wait until you compare that to his monthly EMI on that 40 lakh loan. Assuming an 8.5% interest rate over 30 years, his payment is $30,757. So while Rahul feels like a landlord making money, the math shows he's actually bleeding cash. He has to pull an extra $10,000 out of his salary every single month just to cover the shortfall.
Now you might be thinking, well, rent goes up over time, doesn't it? And you're absolutely right. Fast forward 10 years and maybe the rent finally covers the EMI. But our source material highlights another harsh reality of physical assets. They age. As the rent climbs, so do the maintenance bills. The house is going to need fresh paint, the plumbing will inevitably break, and old fixtures will have to be replaced. The reality is that extra cash flow from rising rent gets completely swallowed up by the endless upkeep of an aging property. So for the sake of our math, Rahul is effectively tying up that extra 10,000 rupees every single month for the entire 30 years.
Okay, so what happens after 30 long years of sweating over EMIs and fixing leaky roofs? Let's assume the property appreciates at a really healthy 10% every single year, which is pretty typical for a growing metro city. That 50 lakh house, it compounds into an absolute monster. After 30 years, Rahul's property is worth a staggering 8.7 crore. From a 12.5 lakh initial investment and monthly cash outlays, he has created multi-generational wealth. Rahul looks like an absolute genius. I mean, that sounds like a massive win, right? But wait, what was Ankit quietly doing with his money over those exact same 3 decades?
Section 3. Ankit's stock market strategy.
While Rahul was dealing with banks and tenants, Ankit took a completely hands-off approach. He takes his initial capital and diversifies it perfectly across the market. He splits it right down the middle between the Nifty 50 large caps, mid-cap indices, and small-cap indices. Because small and mid-caps historically punch a bit higher, his blended realistic compound annual growth rate, or CAGR, averages out to about 15%.
Let's just run the basic math first. If Ankit simply took his initial 1 lakh in savings, dropped it into this 15% yielding portfolio, and didn't touch it for 30 years, it grows to 6.62 crore rupees. Wait a minute. Rahul made 8.7 crore. Does that mean real estate won? Did Ankit actually make the wrong choice here?
Section 4. The 30-year showdown. Well, not quite. It definitely looks like Rahul won the race on the surface, but we haven't made this a fair fight yet. The crucial point is that to make a true scientific comparison, we literally have to match their cash flows perfectly. Remember, Rahul actually put down 12.5 lakhs up front, and he bled an extra $10,000 every single month for the EMI and maintenance. So let's apply those exact same financial commitments to Ankit. In this leveled scenario, Ankit invests a 12.5 lakh lump sum up front. On top of that, he sets up a $10,000 monthly SIP, a systematic investment plan, into his stock portfolio, mimicking Rahul's monthly out-of-pocket property expense. Now the playing field is completely level.
And this brilliantly illustrates the sheer power of compounding without the drag of leverage costs. Rahul's property, as we know, sits at 8.7 crore. But Ankit, his 12.5 lakh lump sum at 15% grows to roughly 8.27 crore on its own. And that simple $10,000 monthly SIP, that snowballs into another 6.92 crore. Add them together, and Ankit's disciplined match stock strategy leaves him sitting on over 15 crore. Just by doing nothing but matching Rahul's exact cash output, Ankit has practically doubled Rahul's net worth. No tenants, no leaky roofs, just pure mathematical compounding.
Section 5. Supercharging returns with AI. But you know, the story detailed in our source material doesn't actually end there. Because we are living in the modern era, there are advanced ways Ankit could push those returns even higher. The source highlights that modern retail investors have access to incredible, automated, data-driven tools. For instance, using platforms like Investing Pro, which the source notes offers a 15% discount through specific links, investors can use AI models like ProPicks. Ankit could select a quantitative strategy, something like Bharat Small Cap Gems. This AI hands him a 20-stock portfolio and tells him exactly what to buy and sell on the first of every month, completely removing human emotion and guesswork from the entire strategy. And the historical, back-tested data on these AI strategies is honestly eye-opening. According to the analysis in the source, if Ankit had used this specific AI small-cap strategy over a recent 5-year period, a mere 1 lakh rupee investment would have transformed into 22 lakhs rupees in just 60 months. That is significantly higher than a standard 15% index return. If you were to extrapolate that kind of optimized algorithmic trading over 30 years, well, the compounding effect would make that 15 crore figure look tiny.
Section 6. The final verdict.
Okay, let's pull all of this together. We've looked at the setup, uncovered the hidden costs, and mapped out the strict mathematical compounding over 3 decades. Here's what you should really take away from this. First, owning the primary home you live in provides unmatched emotional security and stability. Neither Rahul nor Ankit are wrong for wanting a roof over their family's head. However, when you view real estate strictly as an investment vehicle, like buying a second property just to rent it out, the heavy drag of loan interest, stamp duty, and continuous maintenance drastically lowers your real return. When comparing apples to apples, the stock market mathematically outperforms leveraged real estate over the long term. Furthermore, this source points out an incredible, often hidden benefit of stocks: pledging power. Unlike a house, which is highly illiquid, platforms like Lemon allow you to take your massive, let's say 1 crore stock portfolio, and pledge it. You don't sell your stocks, you just use them as collateral. This gives you an 80 to 90% trading margin. If you use that margin for safe, low-risk side trading strategies that yield just 1% a month, you are effectively squeezing out an extra 12% return annually on top of your portfolio's natural growth. You simply cannot do that with a brick-and-mortar house.
So, we've laid out the 30-year journey. We've leveled the playing field, exposed the hidden costs, and shown the sheer compounding magic of equities. The numbers are incredibly clear, and the math just doesn't lie. But ultimately, the choice is yours. Knowing exactly how the math plays out, where are you going to put your hard-earned savings starting today? Real estate or stocks? Think about it and let that guide your next financial move. Thanks for joining me on this explainer.